Welcome to our video on tax deductions. With tax time approaching, it's important for businesses of all sizes to take full advantage of every tax deduction opportunity available. From small business owners to large corporations, effectively planning your taxes can make a huge difference in your bottom line. But that's not all. We're here to support businesses like yours in learning everything they can about maximizing tax deductions. In the description of this video, you'll find a link to our downloadable ebook on tax deductions, available for immediate download upon purchase. Hit the like button, subscribe, and share this video with your network to get started now. Specific tax deductions, charitable contributions, retirement plan contributions, traditional IRA, 401 health savings accounts, HA, mortgage interest and property taxes, itemized deduction, state and local taxes, standard or itemized deduction, medical expenses, education expenses, lifetime learning credit, American Opportunity Tax Credit, business expenses for self-employed individuals and small business owners, strategies to maximize deductions, bunching deductions to exceed the standard deduction, maxing out contributions to retirement plans, keeping records of eligible expenses, consulting with a tax professional to identify potential deductions, staying updated on tax law changes, separating personal expenses from business expenses, choosing the right deduction method for mortgage interest and real estate taxes, standard deduction versus itemized deduction, tracking medical expenses and keeping records, taking advantage of available education tax credits, utilizing tax-advantaged accounts, claiming home office deductions. If you have a home-based business, seeking tax credits for energy-efficient home improvements, claiming credits or deductions for childcare expenses, documenting business-related travel expenses, utilizing deductions for job search expenses if you're unemployed and seeking employment post, keeping track of business-related vehicle expenses if you're self-employed. Summary: there are numerous specific deductions available to individuals and businesses that can significantly reduce taxable income and overall tax liability. By staying informed of eligibility requirements and maximizing deductions, taxpayers can keep more of their hard-earned money and minimize their tax burden. It is important to keep detailed records of all eligible expenses and seek professional advice from a tax expert if necessary. Additionally, staying updated on tax law changes and exploring the use of tax-advantaged accounts can further reduce taxes and enhance overall financial planning. Charitable contributions are donations made to qualified charitable organizations, such as 501(c), religious institutions, veterans organizations, and certain other nonprofit organizations. Taxpayers can deduct these donations as an itemized deduction on their tax return. To claim the deduction, the taxpayer must retain proper documentation, such as receipts and canceled checks, and ensure the organization to which they donated is qualified to receive tax-deductible contributions. Taxpayers who do not itemize deductions can still benefit from charitable contributions by claiming the standard deduction. Charitable contributions made to qualified organizations can be deducted as an itemized deduction on a taxpayer's tax return, thereby reducing their taxable income. To take advantage of this deduction, taxpayers must retain proper documentation and ensure the organization is a qualified charitable organization. Charitable contributions not only benefit the deserving recipients, but also provide tax benefits for the generous donors. Taxpayers may also consider making charitable contributions in the form of appreciated securities, such as stocks or mutual funds. When donating appreciated securities, the donor can deduct the full fair market value of the asset at the time of the donation, without recognizing any capital gain or loss. This can provide a significant tax advantage for donors who have unrealized gains in their portfolio and are looking to support a worthy cause. Another consideration when making charitable contributions is the timing of the donation. Generally, charitable contributions made to qualified organizations during the tax year are deductible on that year's tax return. However, donors can also contribute to donor-advised funds, which allow the donor to make a donation in one year and then recommend grants to qualified organizations in future years. This allows donors to take a larger deduction in a high-income year and spread out the grants to charities over multiple years. For individuals who are planning their estates, it is also worth noting that charitable contributions can be made through a charitable trust. Charitable remainder trusts, for example, allows the donor to contribute assets to the trust and receive an income stream while still living, and then distribute the remaining assets to one or more qualified charitable organizations upon the donor's death. This allows the donor to receive tax benefits while also supporting their favorite charities and creating a legacy of philanthropy. Another way to take advantage of charitable deductions is to consider making donations to donor-advised funds. A DAF is a charitable vehicle that allows donors to make a charitable donation, receive an immediate tax deduction, and then recommend grants from the fund to qualified charities over time. This allows donors to maximize their tax deduction in the year of the donation and take time to research and thoughtfully recommend grants to their favorite charities in subsequent years. For business owners, it's worth considering making charitable contributions through the company. By donating to qualified charities, not only does the company receive the tax benefits of the deduction, but it also enhances their corporate social response profile and strengthens their reputation in the community. Additionally, small businesses may consider participating in employee volunteer programs, where employees can volunteer their time to charitable organizations, and the company can claim a deduction for their expenses. Making charitable contributions can provide tax benefits for donors. They have the option to donate appreciated securities, set up a charitable remainder trust, or a donor-advised fund to maximize their deduction. Businesses can donate through the company or participate in employee volunteer programs for added tax benefits and improved CSR profile. Retirement contributions, such as those made to a traditional or Roth IRA, a 401 or a simplified employee pension (SEP) plan, can be tax deductible. Traditional IRAs, 401 plans, and SEP plans allow pre-tax contributions, meaning contributors lower their taxable income on their tax return for the year of the contribution. Roth IRAs, on the other hand, offer tax-free withdrawals during retirement, but require after-tax contributions. Retirement contributions made to traditional IRAs and 401 plans can also have a significant impact on future tax liabilities. For example, individuals who are in a higher tax bracket when they make their contributions have the potential to save more on taxes than those in lower income brackets. This is because withdrawals from traditional IRAs and 401 plans are subject to income tax in the year in which the withdrawals are made. Therefore, saving on taxes now at a higher tax rate could mean paying fewer taxes in the future when the individual may be in a lower tax bracket. Additionally, 401k contributions also provide the added benefit of employer matching contributions for some individuals. Employers often match a portion of their employees' contributions to their 401k plans, up to a certain percentage of the employee's salary. This essentially doubles the amount contributed to the retirement account, which means more money to grow tax-deferred over time. For small business owners, SEP plans offer an additional way to contribute to their own retirement savings. CP plans allow small business owners to make tax-deductible contributions to their own retirement accounts, as well as for their employees. By contributing to a SEP plan, small business owners can save for their own retirement while also benefiting their employees, all on a tax-advantaged basis. Roth IRAs have the added advantage of tax-free withdrawals during retirement. Since the initial contributions to a Roth IRA are made with after-tax dollars, the withdrawals in retirement are tax-free. This can be particularly beneficial for individuals who expect their tax rate in retirement to be higher than their current tax rate. By paying taxes now, they can avoid higher tax liabilities later in life. Contributions to traditional IRAs and 401 plans are tax-deductible, allowing savers to lower their taxable income for the year of the contribution. Additionally, individuals in higher tax brackets may save more on taxes through these contributions and enjoy tax-deferred growth of their savings. Roth IRAs offer tax-free withdrawals in retirement, while SEP plans provide both tax-deductible contributions and the potential for employee matching contributions for small business owners. All options provide opportunities for maximizing retirement savings while reducing tax liability. Health savings accounts (HSAs) are tax-advantaged savings accounts available to individuals with high-deductible health plans (HDHPs). Contributions to these accounts are tax-deductible, and earnings on the investments inside the account grow tax-deferred. In addition, withdrawals used for qualified medical expenses are tax-free, providing a triple tax benefit. To be eligible, individuals must be covered under an HDHP and not have any other health coverage. HSAs are unique in that they allow individuals to set aside funds specifically for future healthcare expenses. Unlike other tax-advantaged accounts, such as 401s or IRAs, which have a required minimum distribution. When the account holder reaches a certain age, HSAs do not have an RMD requirement. This means that the funds in an HSA can continue to grow tax-deferred for as long as the account holder desires, allowing for potential long-term growth and financial security in retirement. Thank you for watching our video on tax deductions. We hope it has provided some valuable insights to help you stay on top of your tax deductions. For more tax deduction resources, please see the link in the description for our PDF workbook, available for immediate download upon purchase.